Today we're talking about a part of estate planning that catches many families by surprise, the tax that can apply to super on death, and how the proposed new Division 296 tax may add another layer of complexity. Joining us is Shane Nicholas from Independent Wealth Partners, author of Death Tax by Stealth and what the new Division 296 tax means for your estate plans. Hi Shane.
Hey Cam, how are you today?
Do you like the intro?
Well, it's great. I mean, death tax by stealth is a pretty good topic to talk about, right?
It is, yeah. It certainly sort of encapsulates what actually happens. So tell us, you've written this article. What is death tax by stealth, Shane?
Well, you did tell, I'm going to set the scene here a little bit, Cam. You did tell me I've got 15 minutes to talk about this. And in my perfect world, in my finance nerd brain, I'd like to spend 2 hours talking about this topic. So I'll do my best to share 15 minutes. But so in essence, many people don't actually know about this tax.
No,
it often comes out a surprise, when someone says, "Oh, my parent passed away. I've inherited their super account, and I've paid all this tax. What was that tax?"
Yeah.
So
or I didn't think I thought I'd get more than what I ended up getting out of
yeah.
the super.
And it's too late, right? At that point in time, you can't do anything about it. So the notion of death tax by stealth is probably just a play on words, in more or less, because death taxes in Australia were abolished back in the late 70s, early 80s. But there is this overhang of tax whereby a component of a person's superannuation balance is taxed at 15% as a tax rate, sometimes 17%, upon death if it's left to a non-financial dependent.
Yeah.
So very simple example, a parent passes away, leaves their superannuation to their adult child or children, that child will pay 15% tax on the taxable portion of that superannuation account.
Yeah. And I guess part of the question is, when thinking about how this actually works, is so how do you get a taxable portion in super? So for example, would most people have a taxable portion in super, or is it some other version of that, a tax-free version? Maybe?
Yeah, well, I think it's... You're asking me a good question here, Cam. But the taxable portion is basically, we all have taxable portions. Yep. So someone, very simply, their contributions they've received from their employer or from their work, or a contribution they've claimed a tax deduction for, forms part of the taxable portion.
Yep. That's right.
If you choose to add money in yourself with your own money from your own bank account, and you put it in, that becomes a tax-free portion. So that part always remains tax-free, even in death tax, but it's the taxable portion that... catches the tax.
Nice explanation. I think, and so as you'd also probably say that most clients that we see that have built their super, so they've built it up, they've gone through their working life in business or employment or whatever it is, most people will come to us, if they're unadvised, they would come to us with mostly taxable.
Yeah, well, 100%. I mean, ultimately, the reason you add money to super is to, firstly, build for your financial future. But secondly, from a tax perspective, I mean, everyone, this is a really simple example. People use the concept of salary sacrificing, whereby they sacrifice a portion of their salary into superannuation.
Yep.
One of the reasons people do that is to get a tax deduction, right? So the government has, and probably in some respects it makes sense, is that if they're allowed to catch a tax deduction on the way in, then on the way out, they're going to try and catch that back for themselves so that it's a fair ledger. But it doesn't really work out that way because you have accumulated earnings over time.
And I guess also these rules were built when superannuation pools were much smaller too, right? Like we're seeing very, very large superannuation pools now, and the Div 296 tax speaks to that as well. But it can be super significant. So, for example, let's run through an example, shall we? Let's say, we'll pick on me. Touch wood. I die. I've got $1 million. I don't have $1 million in my super fund. But anyway, I've got $1 million in my super fund. I die. And then the proceeds go to my adult children. How much tax am I going to pay?
Well, if
assuming it's all taxable.
All taxable, then it's 150 grand, right?
Yeah.
So it's a big number, right? And that's where I think that's the surprise element, where we say it's by stealth in some respects, because ultimately your adult children probably don't even know what's in your superannuation account. They receive a payment and they see the account balance $1 million less $150,000 in tax, and they receive $850K in the bank or into the estate for distribution.
Yeah.
And that's typically a very regular thing that we see in our world is people come in and say, I've received this money. What was this tax again?
Yeah.
So it's tricky, and it's becoming, I suppose, more complex now. You mentioned before about Div 296, and I'll talk about that in a second. But there's also another concept which has been around for a while now called the transfer balance cap.
Yeah.
And the transfer balance cap is probably the trickiest component of this. And admittedly, it's a fortunate situation where, it started at $1.6 million for people with $1.6 million in super, and it's now up to $2 million. And in essence, what that means is you can have that amount of money in a superannuation account and receive concessional tax. Now, that might on the surface sound like an awful lot of money. However, where the complexity in this comes into the fold is that it's not uncommon for husband and wife to maybe have $800,000 or $900,000 each in their superannuation account, and whilst they're both alive, they're both under the transfer balance cap. One of them passes away. Suddenly, the surviving person may not be under the transfer balance cap, and we now get this situation where we have to be very specific and plan for how to keep as much money in superannuation as we can, and then secondly, set up their future estate so that they don't, cop a whole bunch of tax down the track.
Yeah, that's right. And I know listeners will be interested in your views on this. So, is there a way of being able to reduce the amount of tax that subsequently becomes payable?
It's funny. I say funny. This is my very dry sense of humour coming out here, but I often joke with clients and say, if you knew your last day on this earth, you would never die with money in superannuation. Like that is, obviously, a definitive way to overcome this.
5 o'clock this afternoon, I'm done. What am I doing? I'm taking all my money out of
If I'm old enough to take it out, I'm cashing it all out and I'm putting it in the bank.
Pay no tax. Hey, I don't pay the tax.
No, that's right. But I wanted to use that as an example, though, to sort of further into how you overcome this a little bit, though. But essentially, the significance of that statement, however, is your example before of $1 million, 15% gets taxed, 850 is available for distribution. If that payment was processed from super whilst you're alive, that whole $1 million goes to your estate. So in essence, what we need to be able to do is either I think this is perhaps situational on a stage of life. I know personally speaking that I'll talk to most clients by the time they're in their mid-70s, whether they still need to have superannuation as part of their plan. Superannuation obviously is tax friendly, but if you're getting older and your earnings may be under the tax-free threshold, then perhaps you can mount a case to cash money out of super and rebuild a portfolio external to super and avoid this tax in its entirety. And to be honest, I find as people get older, the idea of paying more tax to the government actually doesn't fill them with joy. And maybe the closer to life expectancy, I think, well, I can bear a little bit of tax personally to avoid my children paying a larger amount of tax down the track. So that's probably more of a psychological or emotional aspect that people seem to change with over time.
Yeah, I guess. And so let's just extrapolate out this example we started with. So there's $1 million you've got in super. It's earning tax free, isn't it? So with the current rules, how it is at the moment, that any money it makes, it's earning tax free. Let's say it makes $50,000, it earns tax free. And then also any withdrawals out of super are tax free. It's essentially your own capital coming back. So that's another thing. But if you were to take that money out, save your kids $150,000 in tax, you take the money out, you invest in it perhaps exactly the same way in your own name, and it generates $50,000 in income, capital gains income, whatever it is. How much tax would you normally pay on the $50,000 that you've generated in your own name?
Yeah, well, if that's, and it's, again, in context, if that's your only asset, then you may not pay any income tax, right? Because you might have, you can probably earn up to $30,000, $35,000 a year and get all the tax offsets that are available to senior Australians. You might have some franking credits in there from your Aussie share portion. So you may actually result in a position where you don't pay income tax. So therefore, the idea of actually not paying any income tax, which is the sole reason why you have money in super anyway, to not pay the tax. So if you can land at a point where you don't pay the tax personally either, but then you're going to save your estate the tax down the track, then it's certainly worthy of a consideration. And again, it's always different for every single person, but it's absolutely essential that you think about that and have a conversation about whether it's appropriate at your stage of life. But I think if I can deviate marginally, Cam, to talk about another example, perhaps a lot of people might have heard of what we sort of financial people call a recontribution plan. So it's quite popular now, and it's now being extended out to the age of 75, provided you meet certain things. But the essence of it is you're actually drawing out money out. I was saying before about that taxable portion of your super account. You're drawing that portion or drawing part of your super account out, diluting the taxable portion of your super account, and recontributing up to 360K back into your super account as a tax-free contribution. So that kind of is essentially having your cake and eat it, where you keep money in your super account in a concessionally taxed environment, but are also eradicating or at least reducing the amount of taxable component and subsequently death benefits tax down the track.
And particularly now with being able to make those contributions back into super, non-concessional contributions back into super up to the age of 75, because that changed. That's opened up that strategy for longer, hasn't it, as well? So
Most
that
definitely.
in combination with maybe not having all of your assets in super.
Yeah.
There's an estate planning implication to all of this, isn't there? So could you explain to our listeners what happens if you die with money in your personal name and also money in super?
Yeah. Well, I think if I can just maybe set a broader aspect to that as well, is that this is probably not a surprising statement by any stretch, is that the importance of actually having a very detailed estate plan is, I feel, is more significant now than ever.
Yeah.
Because even on that recontribution strategy, you can do that multiple times over multiple years, right? So having an estate plan is very, very important to kind of make sure that you're optimizing your tax payable, if you will, or getting rid of as much as you physically have to pay. Because to your point about having money in super versus not in super, again, probably a little known fact is that superannuation actually doesn't form part of your will.
That's right.
So I'll just say that again, because I often this is a question, even clients I've worked with for many, many years still don't necessarily grasp this concept. Superannuation doesn't form part of your will. So essentially, people go off to see their lawyer and they write their estate plan in their will and say, I've got my powers of attorney, medical documents, etc. Here's my will. It's going to be to each other or then to my kids in some way, shape or form. Superannuation is completely excluded from that process. Yep. So subsequently, the need to have a superannuation estate plan through something as simple as a binding death benefit nomination with your super account or some sort of instruction that sits in a self-managed super fund, it has to be done, right? Otherwise, the trustee of your super account will choose for you.
Yeah.
We've all seen the dark side of what happens when the trustee chooses. Most of the time, they get it right, but they don't always get it exactly how the superannuation would have chosen to have it paid if they were making a decision for themselves.
That's right.
Terrifying, actually.
It is terrifying, isn't it? Yeah. And I think that I find that all the time. We're talking with clients, and they just make the assumption, ask a question, do you have a will? Yeah, we've got a will. That's all covered, no problem. This is typically the first response if they have a will. Then you ask questions, well, what have you done with your super? How's that working?
Yeah.
Oh, isn't that covered by the will?
Yeah.
It's just not.
And I think even if you extend it out, I mean, the other side of this is that, the concept, and this, without getting into the technicalities, but a concept of a testamentary trust for adult children, where, and this is a very common thing where parents or clients that we work with might be writing their estate instructions to ensure that their adult children or young children even don't have control of their inheritance immediately. And they do so through a provision of a testamentary trust in their will. If you don't point your superannuation to your estate, that money will never go into your testamentary trust. So the parent or the person might have this great idea that I feel really good about the fact that I've looked after my children, I've put in place amazing plans, paid a very healthy fee to a lawyer to get it written up, but not finalising the superannuation piece means that only part of their wishes will actually come to fruition. And you may have that the whole superannuation balance goes directly to an adult child who they didn't want to have the money now or in the future, right?
Yeah, that's
so
right.
it's not sort of fear-mongering by any stretch, but this happens all the time.
All the time.
Yeah.
All the time. And that's excellent. Now, we've had the introduction of the Div 296 tax. And there is that also adds extra complication in terms of potentially an additional tax when there's a death benefit paid.
Yeah.
Are you able to talk us through how that works?
Look, at a very high level, and I think it's probably important just to clarify here that we are still seeing the devil's in the detail.
Absolutely.
And see how the Div 296 plays out.
And we are going to do a separate, probably podcast session that goes for an hour on this, because there's a lot of things we'll be able to
jump right into the weeds of it.
Yeah.
But again, really what it means is there is a new tax now that's specifically for superannuation, and it is notably for larger superannuation account balances. But what it means at a high level is that superannuation may actually have a 30% tax upon death.
Yeah.
So I suppose the reason why, that's probably as far as we need to jump into it, I feel, but it's probably just worth flagging again the importance of understanding your estate position, understanding where your assets sit, and understanding the intersection between superannuation and non-superannuation assets and how they, kind of join together with your estate plan.
Yeah, that's right. Because they all interact with each other. And I think the importance, and Shane, we see it all the time, but the importance of having that planned for, thought through. People have complex lives, complex situations, thought through as best you can with people who know and understand how all this works is really, really important.
Yeah, look, it is. And I think, sort of, you're kind of wrapping it all together with respect to death tax by stealth. In the absence of actually doing what you've just described there, ad hoc outcomes happen with estate planning. Taxes get paid unnecessarily. And there's a reason, I would say very cynically from my perspective, that this is not publicly talked about in the federal budget every May, is because the government collects a bulk amount of cash from stealth, for death tax by stealth, essentially, right? They just
nothing to see here. Let's not
they're
change
not going to change
this system works really well for us. Yep.
And all we are seeing is obviously in a world where we have large budget deficits for governments, introducing smaller taxes or new taxes is seemingly the theme of the current day. Yeah. So a new tax like a Div 296 tax on super impacts a small portion of the population, but it's still a new tax. So it really is very important to watch this space, because you may find yourself inadvertently paying tax where you just simply don't need to.
Exactly. Yeah. Look, I think that's a good way to finish. We've covered a lot there, but what I would say is, if you're listening to this and you're just unsure about your estate plan, or you're unsure about where your super's going, or whatever it is, feel free to contact us as your advisors, or even people who aren't our clients, and let's have a conversation about it, because it can save a lot of heartache down the track.
Yeah, totally agree. Yeah, and I think if nothing else, people they'll probably enjoy a conversation to get their own mind, that they've got clarity that their estate is actually okay, and that their children, who they all care for deeply, get the outcome that they want for them.
That's right. Yeah. Great. Thanks, everyone. Thanks, Shane. Thanks for coming on.
Been fun. Thanks for having me.
Always is. Thanks, guys. See you later.